Welcome to the Deep Dive. This is where we take, a whole stack of sources, earnings, transcripts, analyst notes, all of it, and we just pull out the core insights to get you up to speed fast. Today, we are ripping open the report that caused a sensation after the close on December 4th. We're talking ChargePoint Holdings and their Q3 fiscal year 2026 results.
Oh, it was explosive, that 4:30 p.m. Eastern drop. I mean, the immediate reaction in after-hours trading was it was high volume. The stock spiked, more than 11% right out of the gate?
With heavy follow-through the next day, too.
Exactly. This was not just another routine report. I think the market was really demanding a change in the story after, a really rough year. And management, they actually delivered a few headline shocks that signaled maybe, just maybe, stability is coming back.
Okay, let's unpack this with the headline numbers first, because they really do tell that story of stabilization. First up, the big one, the revenue beat. They reported $105.7 million.
Which just sailed past the street's expectation.
Easily. The consensus was, somewhere between 96 and 99 million.
Right. And the crucial part here, the really important thing, is that it marks a return to top-line growth. 6% year over year.
That 6% is so important because it completely reverses that trend of decelerating sales that's been plaguing them.
It does. Now, to be fair, the GAAP EPS, that was a miss. Negative $2.23.
Which is a huge loss.
A massive loss. But, and this is a big but, it was largely driven by non-cash items. What investors were cheering for was the non-GAAP EPS. That came in at negative 132, which was a slight beat over consensus.
But if you really want to know what drove the rally, it wasn't the revenue beat, not really. It was the margin expansion. They hit a record non-GAAP gross margin of 33%.
That's not a small jump.
No, it's a 7 percentage point jump from 26% last year. That's huge.
And that kind of jump in margin, it's proof. It's proof of operational discipline and really a successful pivot in their strategy. And you see it on the cost side, too. The adjusted EBITDA loss narrowed a lot, down to $19.4 million.
And last year it was, over 28?
$28.6 million in the same quarter last year. Yeah, they really, really tightened the belt. They're cutting the cash burn.
Okay, that is a phenomenal improvement. But let's ask the critical question right here. Is this sustainable? They've had good margins before, only to see them kind of fall back. What's different this time?
That's the perfect question. And the answer is in the revenue composition. It's the mix shift. This 33% gross margin, it wasn't a fluke. It looks like a structural change. It's driven by their focus on the sticky, recurring side of the business.
Well, subscriptions.
Exactly. Subscription revenue grew 15% year over year to $42 million. And crucially, subscriptions now make up 40% of total revenue. That is the high-margin, predictable stream investors love.
Right. So the higher that subscription mix goes, the less exposed they are to the cyclical, lower-margin hardware business.
That's the idea. And even the hardware side, the network charging systems, that was still robust. It was up 7% year over year to $56.4 million.
So they grew both, but the subscription growth is what gives that 33% margin its credibility.
In the discipline, it wasn't just on the revenue mix. They managed costs aggressively. Non-GAAP OPEX was $57.5 million.
A reduction.
A 2% year-over-year reduction. And cash usage for the quarter, it dropped sharply. Just $14 million, down from $24 million last year. They're watching every dollar.
All of those numbers are strong. They all point to operational stability. But we're talking about a real financial transformation. We have to talk about the thing that happened after the quarter closed. The single biggest move for the balance sheet, the debt exchange.
This was the moment. I think this is when they really convinced the market they were serious about survival. In a privately negotiated deal, ChargePoint did a debt exchange that cut their total outstanding debt by an incredible $172 million.
That's what percentage is that?
That's a haircut of over 50% on their total debt load.
50%. That is a game changer. I mean, for a company that's been battling skepticism about its long-term viability, cutting your debt in half at a 33% discount, That is a powerful signal.
It just changes the whole thesis. It means survival is basically checked off the list and the company is it's healthier immediately.
Yeah.
This move alone is expected to cut their annual cash interest expense by about $10 million.
Wow.
That's $10 million in cash they can now put back into R&D or software instead of just paying creditors. And they push the maturities out from 2028 to 2030.
So they bought themselves time, they cut their cash burn, and they just drastically de-risked the balance sheet. Management called it a pivotal step that's shifting enterprise value to shareholders. And you know what? I agree. In this capital market, this move gives them the runway they need.
Exactly. In this industry where access to capital is everything, having a clean balance sheet is paramount. They've gone from being a high-risk growth story to a de-risked infrastructure play almost overnight.
Okay, so survival seems assured, at least for now. Let's look at how they plan to grow and get to that profitability. CEO Rick Wilmer, he framed this quarter as an inflection point, a return to growth. What's the tech edge that's going to fuel that?
It's all about the software.
Yeah.
They launched the new ChargePoint platform, and they are really stressing that this new stack is heavily optimized by AI. And when we talk about AI and charging, this isn't science fiction. This is about maximizing yield, maximizing efficiency.
So things like real-time monitoring.
Real-time station monitoring, dynamic pricing based on energy costs and demand, and deep analytics on how people are using the chargers.
That makes perfect sense. So the software becomes the brain that makes sure every kilowatt hour they sell is maximizing their profit. It shifts them from just selling hardware boxes to operating a high margin, utilization network.
It really reinforces that they are, at their core, an infrastructure and software company. And the hardware is evolving to support that. You have to look at the collaboration with Eaton.
The Eaton partnership. That feels like a huge validator for their tech. What are they actually co-developing?
Two key things. First, a modular express DC fast charging architecture. And second, a new AC product line that integrates directly with Eaton's smart panel technology. And this is so crucial because this new hardware is explicitly designed for what they call grid edge opportunities.
We're talking virtual power plants, VPP, and that kind of grid interactive charging.
Exactly.
Okay, let's pause here. We need to define VPP and VDG for anyone just getting into this space. What are they, and why is ChargePoint so focused on them?
Right, essential context. A VPP, or a virtual power plant, isn't just about charging your car. It's about your charger and your car's battery acting as a flexible energy asset for the grid. So during peak demand, a utility could pay you through ChargePoint software to either slow down your charging or, in the case of V2G, vehicle to grid, sell power back to the grid from your car.
It's a brand new revenue stream.
A critical new revenue stream for them and for you, the customer. You're monetizing your car battery while it's just sitting there parked.
And the hardware is built for this future. Management was clear. Their new modular DC product is bidirectional, so V2G and V2H, vehicle to home, and it can be deployed with up to 30% lower CapEx.
And lower operational costs, too. They're positioning themselves as vital to grid stability, not just as a service for EV owners.
And it seems to be working commercially. They renewed their Sourcewell contract.
Yeah, that's their third consecutive award. It gives them continued access to the public sector and government clients across the U.S. and Canada, which is a massive, sticky market.
And beyond government, they're seeing traction with commercial fleets and destination charging. They mentioned the city of New York and a new program with BMW North America.
And we should also mention geography. Right now, North America is like 85% of their revenue, but they really highlighted Europe as an accelerating growth engine. They expect European revenue to really ramp up in the second half of calendar year 2026.
Okay, so we've got growth coming back. Margins are skyrocketing because of the software mix, a de-risked balance sheet, and a powerful story around the VPP market.
Right.
So why isn't the stock back at its old highs? We have to get to the reality check now, the challenges ahead.
And this is where we talk about the elephant in the room that's keeping analysts from going, full throttle bullish. And that's inventory. It is still massive. It's sitting at $212 million.
And that inventory is the old hardware, right?
Yeah.
The higher cost stuff.
Precisely. So while management is promising a gradual reduction, this inventory is a drag on cash flow. And crucially, it delays the real margin benefits from the new products. They confirmed investors won't see the full margin impact from the new, lower-cost products until the second half of the next fiscal year. They have to sell through that $212 million backlog first.
That makes perfect sense. And it justifies the valuation gap we're seeing. I mean, despite this great quarter, the stock is still down 61% over the last year. The clean energy ETF, ICLN, is up over 42% in that same period.
There is a massive amount of lost ground to make up. It's going to require just relentless execution from here on out. And their forward guidance, it reflects that caution. For Q4, they guided revenue to 100 to 110 million.
Which is only about 3% growth at the midpoint.
Yeah, it's a little above what analysts were thinking, but they stopped short of giving an explicit date for when they expect to hit profitability.
So what does this all mean for you, the listener? The analyst tone is, I'd call it cautiously bullish. This quarter was a credible step in a longer recovery arc. It shows stabilization, better margins, a stronger foundation.
But the path to GAAP profitability is still narrow. They're dealing with that big inventory backlog and, a broader slowdown in US EV demand growth. Execution on that software strategy is now the only thing that matters.
And now we get to the part of the deep dive where we take this whole structural story and pitch an outrageous but plausible trade idea based purely on what we just reviewed.
And just a reminder, this is purely for entertainment and discussion. We're summarizing public information, not offering personalized financial advice. Please consult a qualified professional. This is not financial advice.
Okay, so if you look at the fundamental shift here, that huge $172 million debt de-risking, and the clear pivot to a recurring revenue and VPP infrastructure model, the opportunity here shifts from a sort of Hail Mary bet to what we could call a de-risked growth arbitrage. The question is, how do you invest in a story that might take 2 or 3 years to play out?
Go on. Because the near-term noise from inventory and slower EV sales makes just holding the common stock a pretty volatile proposition.
Exactly. So the idea is simple. You bypass the near-term headwinds and the day-to-day volatility by going long ChargePoint using deep-in-the-money leap calls dated out to 2027 or even 2028.
Okay, so for listeners who might not trade options, a leap call is just a long-dated option contract. It lets you make a really bullish bet on a stock's turnaround without tying up all the capital you'd need to buy hundreds or thousands of shares. It's leveraged exposure to the upside with limited initial risk.
Precisely. It's a bet on the structural turnaround itself. The debt exchange ensures survival. The Eaton partnership validates the tech. And the stock is still trading in the basement compared to its long-term potential. This long-term call lets you capitalize on that turnaround narrative and the leverage from the software shift while you sidestep the noise of the next few quarters of selling down old inventory. It's a conviction play that the future is grid-edge software, not just cyclical hardware sales.
It's a high-conviction, long-duration position. It requires patience. You're banking entirely on the balance sheet strength, giving them the time they need for that software platform to really take hold. It's a plausible, leveraged way to capture the upside if this turnaround succeeds.
Okay, let's wrap up this deep dive with the 2 most important points for you to take away from ChargePoint's Q3. 1, revenue growth is back, and it's powered by that crucial high-margin subscription mix. That shows a successful pivot away from just pure hardware.
And 2, the balance sheet is dramatically healthier. That $172 million debt reduction gives them the stability they need to execute their plan over the next few years.
But let me leave you with one final provocative thought that builds on everything we've covered about the future. Given management's aggressive focus on VPP and grid services, and this V2G and V2H technology, is ChargePoint's biggest competition no longer other charging networks like EVgo or Electrify America? Are they now starting to compete directly with traditional utilities and established grid-edge tech companies for control of the entire distributed energy market?
That completely reframes the industry and the whole investment thesis. It changes everything. That's a fantastic point for you to mull over as you digest this report.
That's all for this deep dive into the ChargePoint Q3 print. Thanks for joining us. We'll see you next time.